Hi everyone, welcome back to the channel. As of now, we have discussed question number 1 to 9 of valuation series. We are discussing the basic questions now because these questions are taking a lot of time, and I actually wanted to make smaller videos. We actually had to conclude our last session till question number 9 only. So, without wasting any time further, let's start with question number 10. So question number 10 is an excellent question. This is a very important valuation concept that often shows up in investment banking and private equity interviews. So let's go step by step. The question is that when you are looking at the at an industry specific multiple like EV enterprise value uh, divided by scientists or enterprise value divided by subscribers, why do you use enterprise value rather than equity value? So the short answer for this is you use enterprise value because a metric like the number of scientists or number of subscriber represents represent resources or values driven resources or drivers that are available to all investors, both debt holders and equity holders. But you need to understand the underlying concept like the enterprise value versus equity value. So enterprise value actually represents the total value of entire company, the core operations. And equity value represents the value of just the shareholders' equity. Enterprise value belongs to all capital providers. It includes debt, equity, and preferred equity also. But the equity value is only belongs to equity holders. And the common multiples of equity enterprise value are EV, EBITDA, EV revenue. And the common multiples for book value are price to earnings and price to book value or price to earnings, price to equity also. So the key idea here is that the numerator, if you're talking about the numerator, EV or equity value, and the denominator, the financial or operating metric, should match in terms of who owns or who benefits from the metric. Why the enterprise value for a metric like scientists or subscribers? Let's take an example. So if we say that enterprise value to scientist ratio, suppose you are valuing a biotech company based on the number of scientists working in research and development. So those scientists create intellectual property and potential future drugs. The value generated by their work benefits all the investors, both debt and equity holders, because the company's total enterprise value depends on their work. And it's not just shareholders who benefit from the discoveries, debt holders' risk also decrease if the company becomes more valuable. Therefore, appropriate multiple is enterprise value to scientist, not equity value to scientist. And in second case, if we say enterprise value to subscribers, let's assume that it's a telecom or a streaming company. Suppose we value Netflix or a telecom provider. So subscribers are the foundation of the company's revenue and profit. The value created by each subscriber contribute to the company's entire business, which support all capital providers. And subscribers generate cash flow that go towards paying interest to debt holders and a dividend to equity holders. Hence, you use enterprise value to subscribers, not equity value to subscribers. So, in these cases, enterprise value to scientist or enterprise value to subscriber makes sense, not an equity value to scientist or equity value to subscribers. And when should you use these equity? When should you use and equity values? Instead, you can use equity value when the metric applies only to shareholders. Meaning after debt holders are paid. So the examples would be price to earnings multiples. Price is actually equity value and earnings is actually the net income. which is after interest. So for consistency, both numerator and denominator will be equity focused. So that's why price to earning ratios in when you are using price to earning ratios, that in that cases equity value should be used rather than enterprise value. And a quick consistency rule which I would like to share with you guys is that if the metric type is before interest expenses, it will belong to all investors. So let me just share my screen with you, my whiteboard with you guys. So a quick consistency rule will be metric type and who does it belongs to and what should you use. If you are using a metric which is before interest expense, like revenue, EBITDA, EBIT, subscriber, scientist, it will belong to all investors. And it's better to use enterprise value based multiples in this scenario. But if you are using a metric which is after interest expenses like net income, EPS, book value of equity, so it will belong to only equity holders. And it will be better to use equity value based multiples. Now, if you observe closely, interest before interest and after interest. So what's dividing these two is interest component. And you know that very well, interest is related to debt. So if it's before interest, if a metric type is before interest, then it will belong to all investors because it will include the debt component also. But if the interest is paid, then it will be then the component will be the metric type will be it will belong to equity investors. So in that case, equity value based multiples will make much more sense to use. I hope this was clear. And in summary, if we think about it, uh, on the basis of scenario, metric available, metric available to and correct multiples. If we think about telecom valuation, so the metric will be subscriber and it will be available to all investors. The correct multiple will be enterprise value to subscriber. If in case of a biotech company, the metric is scientist, it will be available to all investors. Again, and in that case, the correct multiple will be enterprise value to scientist. But in case of a retail valuation where the metric is net income, here the metric is net income. Here the metric is net income. So it will be available to equity holders only. And we have discussed previously that before interest or after interest. If it's after interest, net income is derived after interest. So it will be available to equity shareholders only. And the correct multiple here will be based on book value. So price to earnings, price to equity value. So E here represents equity value. And for a SaaS valuation company where revenue is the metric which we are going to use, so it will be available to all investors all. So the correct multiple here would be to use enterprise value to revenue. And the final takeaway with this uh, question is, let me just share my screen. So the final takeaway is that always match the numerator and denominator in your multiple. If the denominator represent a company-wide measure before interest, use enterprise value. And if it represents a shareholders only measure after interest, always use equity value. I hope this was clear. So let's move to question number 11. Question number 11 is about LBO or DCF, which gives higher valuation. And absolutely, this is one of the most commonly asked question, conceptual question in finance interview and underlying why an LBO typically gives a lower valuation than a DCF is crucial. So let's break it down carefully. So question is why would an LBO or a DCF give a higher valuation? So both methods are used to value companies, but they approach valuation from a very different perspective. Uh, let's recap what these methods are. So DCF is actually discounted cash flow, and discounted cash flow is, as the name suggests, cash flow. So free cash flows are, it includes free cash flows during the projection period and a terminal value. So we discount back these to today with the help of weighted average cost of capital. We need a rate at which we will be discounting it back. So the rate at which we discount is weighted average cost of capital back, and then we calculate the DCF. In a leverage buyout model looks at the business model from the perspective of a private equity investor. And you assume that you acquire the company using a mix of debt or equity, and you sell the company after a few years, typically 5 to 7 years, and you target a specific IRR, say 20 to 25%. So the key question in an LBO is, what is the maximum price I can pay for this company today and still achieve my target IRR? Unlike a DCF, the LBO does not directly calculate a fair value. It instead backs into a valuation based on the required rate of return. And why does an LBO usually gives a lower valuation? So we have previously discussed that. If you look from the perspective of DCF, so DCF is long-term investors valuing future cash flows, and LBO is a private equity buyer targeting specific return. And the value drivers for a DCF are all projected cash flow plus terminal value. And for an LBO, only exit value plus debt pay down plus cash flow available to equity holders is a value driver, because we have taken a huge amount of debt to acquire the company, and we would at least want that we can pay at least the interest component. If the interest, we are not able to pay the interest component of the debt also by acquiring, after acquiring the company and making it running, so it would be a bad deal. So the value driven the drivers of value are exit value plus debt. We need to pay the debt pay down and the cash flow available to the equity holders. Time horizon, it's the time horizon for a DCF is long, and the time horizon for LBO is 5 to 7 years. So in within 5 to 7 years, we would want to acquire a business using debt, pay off our debt, and sell it at a profit. So that's why LBOs uh, have a lower valuation. And the discounting rate, it depends on WACC, weighted average cost of capital, for DCF. And because the DCF discount rate would be in sync with the inflation and the uh, with the what the peers are saying. So a consensus a consensus rate of return, a consensus discounted rate. But in LBO, the discount rate would be high. So it will, because an LBO requires a higher rate of return than the WACC, weighted average cost of capital used in DCF, the implied purchase price must be lower to meet the return target. And uh, the conclusion is that the LBO valuation is typically lower than the DCF valuation. Higher discount rate, we have talked about it. It ignores intermediate cash flows because only exit matters. We will be selling it back. We will be selling back the business, and it values the company from a more conservative return focused perspective. LBO. And when could an LBO given higher valuation? If you think about it, it's possible but rare. It could happen. The target can support very high leverage, boosting equity return, and the purchase price, the if the purchase price is low, like distress asset, operating the operating improvements or multiple expansion at exit are substantial. In those cases, an LBO investor might value the company higher than a DCF because the expected returns are huge. So, in short, a DCF values a company based on what's its worth as a business, but an LBO values a company based on what an investor can afford to pay and still hit their return goal. So, if the return goal is at least 20 to 25% uh, uh, per year, So that's why the LBO gives a lower valuation. I think we have covered everything in this question, and this was actually an excellent question, which is asked in interviews. So let's move to question number 12. Question number 12 is about how, uh, let's break down the question first in detail and understand what does it mean and why it's important and how the football field chart helps presenting valuation results. So the question says, would you present these valuation methodologies to a company or its investors? How would you? Usually, you would use a football field chart where you show the valuation range implied by each methodology. You always show a range rather than a specific number. This is a how investment bankers or analysts communicate valuation result, not calculate them. So the purpose of the question here is when valuing a company, there are several methods. So we have discussed, apart from the conventional methods like DCF, comparable companies, and precedent transactions, there is LBO and other more LBO and more, and each gives a different range of values depending on assumptions. So the goal is to show these results clearly and visually, not just dumb numbers in the table. And that's where football field charts come in. So just give me a moment. I will just show you what does a football field looks like. Just give me a moment. Okay, I hope this is visible. If you look at the diagram here, so this is how a typically football field looks like. Or Okay, so this is what a typical football field looks like. I have just Googled image. So the investor is or the analyst is valuing a company based on DCF. The valuation of DCF is in between. If they look at the base case is the valuation of the stock is 65.5 to 85.9, in between 85.9. If you look at the adjusted case terminal value, so it's between 96.7 and 127.4. So football field gives you a valuation, a range of valuation here. After precedent transactions, the valuation is in between 56.3 to 97.7 in between. And this range shows the median valuation. So here it's a little above 100. If we do a comparable public company analysis, so the valuation of next year is somewhere around 65.8 to 112. So this is what does a football field looks like. So we will use all the valuation from all the different methodologies, and we will try to find a median value in between those. So this is a typical football field, how a football field looks like. So I hope this was helpful. Let me just show you one more diagram, one more chart. Let me share my whiteboard. Okay, here. Here, this is a simple football field chart. It's for a company A. So 52-week trading range shows that in 52 weeks, which is a year, the stock has been in a range of 22.68 to 40.54. And the current analyst who has forecasted, they have forecasted that the stock should be in a range of 45 to 48. The basis of this is this current analyst forecast comes from comparable valuation. So the comparable valuation, if we have used the comparable valuation metrics, we have forecasted that 31.81 to 63 43.9 should be the range. As per precedent transaction values, the range should be 44.81 to 65.9. And as per DCF valuation, our range is 36.81 to 55.90. What the analyst has inferred from these three valuations is this 45 to 48. So the median here is a little above 45. I mean, is the median here is in between 45 to 50. It's difficult to say. So it's in between 40, it's above 45 and below 50. So that's why the range is in between 45 to 48. They have taken a range of 45 to 48. The current analyst has forecasted this thing on the basis of these three. And previously, the stock has been trading in between 26.68 to 40.54. That's how you actually read a football field chart. And you can use all kind of valuations to make this football field chart. And you can do some adjustments also when we will study about this when we will do a practical question on we will value a company, and I will try to value different companies from different sectors so that you get a better understanding of what we are in. So we are done with question number 12, and this was question number 12 was actually a great question, and the purpose of football field is to represent. I mean, football field is a horizontal bar chart. It shows valuation range for each method. So just like one you saw, so each bar represented a valuation range, and that's why it's called football field. Okay, let's move to next question, question number 13. So question number 13 is a nice, it's a very nice question. The interviewer is asking about valuing an apple tree, and think about it. So valuing an apple tree is a perfect way to make valuation methods more concrete and a little fun. So you can treat it like a company. So if you are valuing an apple tree, you can use relative valuation or intrinsic valuation. Based on relative valuation should be based on market, or intrinsic valuation should be based on cash flows. So here the cash flow should be the apples, and relative valuation should be the prices of apples. So let me walk you step by step. So relative valuation, if you think about relative valuation in this question, relatively if you try to value it, ask yourself what do other apple trees sell for, and scale those prices to your tree. And how do you do that? You first find comparables. You go to local nurseries, sales auctions, farm sales classified as mature trees or orchids, and then you choose a unit to compare. Price per mature tree, price per kg of annual harvest, and or price per hectare of orchids. Then you convert the comparables to a common multiple, like price to annual net apples, how much apple production has been per tree, because there are different varieties of apples also in the market. So you adjust the difference, tree age, variety, everything. You need to have all the data: yield, health, soil, irrigation, local apple prices, and how much cost do you relatively how much cost as per the variety of the apple. Uh, so and the pros and cons. So let's assess the pros and cons. So pros could be fast, and I mean, it if we are using a relative valuation, so it will be fast because we can get the data from the market grounded, and reflect real buyer sentiment. And the negative side, downside of this relative valuation using to value an apple tree should be that uh, maybe scarce or not truly comparable, like age, variety, and location. So I mean, the age of the apple tree, the variety of the apple tree, and the location of apple tree, where it has been originated from. So these are difficult things to capture. And buyer can value non-cash aspects differently, like ornaments and shades. So they cannot be, I mean, so those are the downsides of using a relative valuation in context of an apple tree. And if you think about the intrinsic value, so the idea here is to estimate the future net cash flows that tree will produce, like apple sold minus cost, and discount them to present value. So if we were to do it in a step by step format, so we can do what we can do is estimate annual gross production. We can do that. We will be needing some produce first. Then we can estimate the price of the produce. Then we can subtract the cost, like pruning, fertilizer, pest control, water, transportation, and all those things to get an annual net cash. So revenue should there should be some revenue, there will be cost, and then we will get the net cost, net cash flow, and we will decide to forecast over a horizon of the age of the tree, like for example, 10 years, and a terminal value that the value after the terminal value means after a value after the explicit forecast perpetual growth or exit multiple. And we can choose a discount rate also. So in DCF, discount, if we are using DCF, we will actually have to have a discount rate, and we can discount all those future cash flows to today. Yeah. So practical adjustments and items to inspect practical adjustments and items which we need to inspect in this question should be like age and the remaining productive life. Young trees ramp up, old trees decline. Uh, Variety of apples, health, trunk damage, root diseases, scab, and all those kind of things. Location should be also considered, like urban lot or orchids. And the thing about apples is that apples are grown in those areas where there is snowfall only. Because if there is no snowfall in those areas, though the apple produce, it actually doesn't. The taste of the apple loses its taste unless until and even the water availability and irrigation, legal restrictions, one-time cost of grafting and other things, pest control and non-monetary values. Uh, so when you are, if you are valuing an apple tree, you look into this much detail. So when you are valuing a company, so you can get a rough estimate of how much attention to detail you have to pay. And the bottom line here is that value, what what a comparable buyer would pay, and which is market comps, relative valuation, and what the present value of the tree expected future cash flow uses both reconcile the range and adjust for age. There are always factor in all the possibilities, like uh, reconcile the range, adjust for age, health, variety, location, risk. So this is how actually you value an apple tree. So you actually have to look into a lot of things, agricultural aspect, market aspect, uh, and other things. From different angles, you actually have to understand irrigation, life, production. This was a very good question for to test how deep you can think about a business. So let's move to question number 14 without wasting any time further. The question number 14 is also an excellent question. This is the core concept of valuation, actually. So let's break it down step by step so you can fully understand why equity value to EBITDA is not used, but enterprise value to EBITDA is. So we have discussed that equity value and enterprise value, there is a difference that equity value represents the value that the value of shareholders' ownership in the company, and enterprise value represents the total value of the business, which includes equity holders plus debt holders plus preferred shareholders and minority interest, and we subtract the cash at the end of it. And if we talk about EBITDA, so EBITDA stands for earning before interest, taxes, depreciation, and amortization. It measures actually companies' operating performance, EBITDA, the profit generated before considering financing and taxes. This means EBITDA is available to all investors. So debt investors, because of the interest component, and equity interest, since residual profits go to them. So EBITDA belongs to the whole firm, not just to the investors, to the shareholders. So the simple analogy is that uh, if you think of this as a piece of cake, so the whole pie will be enterprise value. Slice after paying debt holders will be equal to equity value. And EBITDA represent the total size of the pie before paying anyone. So enterprise value compares the total value of the total earning power, but equity equity value to EBITDA compares one slice of the pie. Think about it from a perspective of a pie. Misleading so equity value to EBITDA is actually misleading. You can say that it's misleading or inconsistent. That's why. Because equity value only considers the ownership of the shareholders, and enterprise value considers the ownership of the whole firm or the all the investors. All right, so let's move to question number 15. 15 Question number 15 is one of those valuation concepts that sound simple, but the reasoning behind it is this thing is very quite deep. So let's unpack what liquidation valuation is, and why it is usually the lowest when it could actually be the highest, step by step with examples. So liquidation valuation, if you look in the definition of the liquidation valuation, it actually estimates how much money a company's investor would receive if all the assets were sold off. So liquidation, I'm liquidating the company and all the liabilities are paid off. So I'm liquidating the company and I'm paying all the liabilities, and whatsoever is left, it goes to the shareholders after before paying the debt holders. So there could be two cases, two types: going concern liquidation, assuming that the company sells assets in an orderly way, not immediately, or fire sale liquidation, assuming that the company must sell asset very quickly, often at discount. So we can do it slowly or we can do it fast. So the formula for liquidation value, if you think about this liquidation value formula, so we will sell all the assets, we will get some money, and we will pay our liabilities owned. So that's why and why do we use liquidation? Why liquidation value is usually the lowest is normally if a company is alive and profitable, the assets are being used to generate future earnings. Other valuation methods like DCF and precedent analysis and trading comps factor in this future potential also. But liquidation value, however, ignores the future earnings. Because we are selling all the assets, we so this makes no sense because uh, if we do not have assets to generate future income, so there are no future earnings because we are selling everything. So we do not have any assets to generate any future revenue. So liquidation valuation, however, ignores the future earnings and it only considers the cash you get today to pay off uh, the company's liabilities. And when a liquidation value could produce highest value in rare cases where a company's hard assets like land, building, machinery, and inventory are extremely valuable, but the market is undervaluing the company due to temporary earning issues or market cyclical nature of the market. And in these situations, the company's comparable metrics and precedent transaction and DCF valuations, and it would all show lower values when the liquidation value based on the fair market value of the asset could exceed them. So this could be a reason. When would a liquidation value produce a highest value? This is very rare, but yes, this could be done. This could happen. This scenario. So yesterday we discussed that there is no black and white or right or wrong, but there is a lot of gray area which we need to explore being a finance analyst. Let's move to question number 16 now. Question number 16 is a classic interview topic. So I will explain why you would value an early stage zero revenue company like Facebook using creative multiples and how to do it, and give a concrete interview friendly example. And uh, so the first question is, why not regular DCF? So DCF requires, we have discussed that, cash flow, discounted cash flow. So you cannot use DCF unless until there are cash flow. A credible forecast of future cash flow should be there. And small changes in assumed timing or margins blow up the terminal value. It gives a false precision because there are no cash flows. So I will be assuming something, then it will not reflect. If everything is based on assumption, so there is no correct answer. And in interviews, you will get penalized for inventing implausible and long range cash flows assumptions because they do not represent the market also. So if you are saying something, it should be credible. And if we are not using DCF or Facebook, so we should be using comparable companies comps, because in 2004 Facebook just started, and we did not had that much data about Facebook. So what we can do is we can use comparable companies and precedent transactions here to value Facebook, like enterprise value to monthly active users, MAU, or enterprise value to daily active users, enterprise value to unique visitors, enterprise value to page views, uh, and apart from that, enterprise value to app installation, enterprise value to sessions, enterprise value to time spent, depends on the product. Also, these kind of metrics can also come into play, and these metrics are direct proxies for monetizing potential. So, uh, since these kind of companies are in the market, so we have explored a lot of unexplored area. So, Facebook Marketplace, uh, it's popularly a marketing platform. Facebook is used for marketing and sales as a marketing and sales platform. Intuition behind these multiples is that EBITDA, revenue, and net income measures past or near-term cash flows. For a user growth company, value comes from future ability to monetize users' attention. And here in this question, the interviewer is testing that, do you understand the metric actually, the driver's value for a company? And can you find or justify the comparables and adjust multiples logically? Or can you map operational metrics to money like ARPU, conversion, and retention? So DCF is very widely used, but uh, DCF doesn't apply everywhere. So the short and sharp answer for this question would be that for 2004, there were no revenues. And so you should value using user engagement and users or engagement multiples for comparable social platforms. For example, enterprise value to MAU, monthly average users, or page view. because EBITDA or revenue multiples are not meaningful for a company which is just a startup. Even today, Facebook is a big company, but in 2004, Facebook was just a startup. So applying a multiple range based on comps adjusted for growth and attention quality, and then sanity check for the result by converting implied enterprise value into ARPU, average revenue per user, and the revenue scenarios. So if needed, you could run scenario DCF using explicit monetized assumption, but only as a cross check, since long range cash flows are unreliable here in this case. I hope this you have understood this question. Okay, let's move to question number 17. So question number 17 states, and this is another core valuation concept, and it's built directly on the logic from your previous question, enterprise to EBITDA. So let's go step by step. So if you recall free cash flow, levered, unlevered free cash flow, this free levered, unlevered free cash flow, which actually is available to all investors, both debt and equity holders. So it represents a company's operating cash flow before paying interest or repaying debt. If you remember the formula for unlevered free cash flow, so it includes EBIT. We multiplied it with 1 minus tax rate earlier. If you remember the formula, or if no, no problem. We will discuss it in for future questions. We add back our non-cash charges. We subtract capital expenditure and the changes in working capital. So if a company had no debt, uh, how much cash would its operations generate that could be distributed to both lenders and shareholders? This is unlevered free cash flow. If a company had no debt, so unlevered free cash flow belongs to everyone who invested in the business, equity and debt holders. And levered cash flow, we received levered cash flow after uh, paying the interest and debt component. So levered cash flow actually starts from net income. We add back the non-cash charges. We subtract the capital expenditure. We subtract the changes in working capital and the mandate. We subtract mandatory debt, and we add back new debt issued. So interpretation of levered cash flow was uh, how much cash is actually left after shareholders after the company services its debt. So understanding through the trick in this question is the question says what would you use in conjunction with free cash flow multiples, equity value and enterprise value. And the answer begin with this trick question. That's because free cash flow can mean two different things, levered, unlevered. And you cannot answer until you know which one you are talking about. If it's levered cash flow, you can use enterprise value, and enterprise value to unlevered free cash flow. But if it's levered cash flow, so levered cash flow is only for equity holders. Just understand this thing. Unlevered and levered. So you actually have to understand the difference between unlevered and levered cash flow. So unlevered cash flow is for both equity and debt holders, and levered free cash flow is for only equity holders. So if it's unlevered free cash flow, you can use enterprise value. But if it's levered free cash flow, you will only use equity value. Okay, so let's move to question number 18 now. Question number 18 is yet again an important question in valuation multiples, especially when comparing financial versus non-financial companies. So let's do a step-by-step analysis of this question now. So if you remember what makes a good multiple, is that it matches the numerator and denominator of stakeholder group like equity and enterprise value, and uses consistent logic, pre and post, pre and post taxes, and reflects how the business generates value. Now notice that enterprise value to EBITDA, enterprise value to revenue, and equity value to revenue. Here they are using equity value to revenue, and here they are using equity value to EBITDA. This is because revenue is a pre-debt measure. So normally enterprise value makes more sense, and equity to revenue does not. And why do we why we don't normally use equity value to revenue is because equity value represents the total shareholders equity, total shareholders only, and revenue is the total sales before any expenses including interest and debt. So equity value to revenue would be value to shareholders and revenue available to all stakeholders. I mean, this means that we are mixing apple to oranges because this metric is only for equity holders and this metric is for the whole company, whole firm. And here again, this metric is for the equity holders and this metric is for the whole firm. So we are mixing apples to oranges here. And that's why it's wrong. Equity value, if we would have used in revenue here, so it would have net income, it would have made more sense because then it would be consistent. Consistent because this would the numerator would be of the numerator would go to equity shareholders, and net income also goes to shareholders. Equity value to revenue, or if it was earnings, so it would have made more sense because then both shareholders, then because both of this would have only included the shareholders. Here it's in the above numerator is including the shareholders and the denominator is including the whole firm. Here also the same situation has been. So there could be a rare expression, there could be a very rare exception when equity value and revenue can be used, and financial institutions with negative or tiny enterprise value can use these. Banks, insurance companies, or large financial institutions often hold large cash balance, have low debt or no debt, and sometimes even have negative enterprise value where cash is greater than debt plus market cap. So in that case only we can use equity value to EBITDA, but these are very rare, these are very rare exceptions. Uh, simply equity value to revenue Equity value to revenue is rarely used. It's mismatch between numerator and denominator. It's used for banks and institutions with negative and meaningless enterprise value. If the enterprise value is meaningless, then only we will use these kind of metrics, these kind of ratios. Why used? For comparison and presentation consistency, could be the reason only. And preferred multiple for banks are price to earnings or price to book value, not equity value to revenue or equity value to EBITDA. So even if these are rarely used, still then they would be useless anyway. And imagine if you could imagine enterprise value as a total size of the company's operations and equity value as what it belongs to shareholders. For most companies, it's fine to use total company metrics like EV by EBITDA or EV by revenue. But for bank, the only way they make money is via interest and deposit. And hold deposit means total operations are equal to shareholders' equity only. So banks can use this kind of metric, but even though banks will use these metrics, they will be useless for the bank also because the preferred metrics will be PE by P price to earnings and price to book value anyways. So even yes, there are always exceptions, but this will be a useless exception. Let's move to question number 19. So question number 19 is again an excellent and a most practical and important question in valuation interviews and financial analysis. So first, understand the context is when valuing a company, analysts often use relative valuation methods such as comparable company analysis and precedent transaction analysis. So comparable company analysis is how similar companies are being traded. I mean, how are similar companies currently valued in the market? And precedent transaction analysis is what prices have been paid for similar companies in past merger and acquisition deals. So as of now, after 19 question, I hope comparable company analysis is comparing companies in the market. Precedent transaction analysis is done when how much the previous merger and acquisition deal, how much price has been paid to acquire a similar company in previous merger and acquisition deal. And then the third one was DCF. I hope you have understood the concept, I mean, at least the basics of the concepts. Comparable, the ratios, precedent are the merger and precedent transactions are related to merger and acquisition. So to do either of these, you must first find a set of comparable companies or debt. For comparable companies or deals, that's what this question is about. Uh, the main selection criteria is industry classification. First, we will classify the industry. Then the industry classification would be you start to identify companies by the same industry or sub-industry. And the idea is that the companies in the same business tend to have similar risk and similar growth rates and similar margins. So their valuation multiple are like enterprise value to EBITDA, price to earnings, and other comparables. Industry is always the first to screen. So always screen for industry first. I mean, industry classification is to be done primarily. The first is the industry classification. The second criteria is financial criteria, which involves revenue, size, profitability, and growth. So revenue, EBITDA, etc. So uh, within an industry, companies can vary a lot. Some are huge, some are small. So usually match companies with similar size and performance metrics to get a better picture. Uh, this ensures your comparables are similar in scale and economies. Uh, And the third criteria, companies, the third and the third way to select is for as per geography. So location affects valuation due to differences in market condition, cost structure, government regulations, economic growth rates also. So you compare companies operating in the same region or similar economies. Then you can start with additional criteria for precedence transaction. For precedent transaction, you use the same three filters as above, plus one more time period, deal date here, precedent transaction. So time period, deal date, that's because market changes, valuation from 10 years ago might not be relevant today. So generally limit your search to transactions within past 1 to 2 years or within a time window representing similar market conditions. Then start putting it all together. So when you are doing it, how do you select a comparable company transaction, comparable company or precedent transaction? So this is how you do the three. First, you use the three criterias. Then you look into the time factor, additional criteria, and um, then what we do is we put it all together. What it shows: selection criteria, data sources, valuation, multiple examples, and time relevancy. Then we start the screening process. Uh, and doing it, why it's important is that choosing the right set of comparable companies or transactions is crucial because they directly determine the valuation multiples you will apply. Uh, I mean, a poor selection will distort your valuation. Think of it as a real estate. To value a house, you look at the recent sales of similar houses nearby, not skyscrapers or old castles, and not houses in other continent. So here are the few examples also in the explanation. Common company screen. Oil gas producers with market cap of $5 billion. Comparable company screens digital media companies with over 100 million in revenue. President transaction screens airline M&A transaction over the past 2 years involving seller. So that's why after all these, after the first 3 points, you look into the date time relevancy factor also. In precedent transaction screening, retail M&A transaction over the past years. The precedent transaction, you often limit this set based on date and only look at transaction within the past 1 and 2 years. The most important factor is industry. This is always used to screen for companies transaction, and the rest may or may not be used on depending on how much specific you want it to be. So uh, this was a great question, and the initial and these are only the basic questions. We have not moved to the advanced question as of now. So this will be the found. These questions will be the foundation for advanced questions. And when we will do the relative or when we will learn about the valuation concepts, these questions will actually be very helpful. So basically, what happens is first we start with the theory, then we go to the questions. But if you can understand, I can hope. I assume that you guys have little or no experience in valuation, but you might have heard of valuations. So to test your concepts, the best way is to do questions. But we are doing questions first, and then we will test our concept when we will do the theory part. So you will understand, you will know what are the major concepts, and you will know where exactly and what do you are actually looking for. So let's move to question number 20 now. So question number 20 is the key question applied in valuation interviews and finance work. So let's break it down. So the three core valuation methodologies, we have discussed it previously also: comparable company analysis, precedent transaction analysis, and discounted cash flow. So precedent company analysis is based on market value of similar public companies, and precedent transaction analysis is based on multiples paid in past merger and acquisition deals for similar companies. Previously, in the last question, also we have discussed that. The and discounted cash flow is based on present value of future cash flows. And the output for precedent, the company comparable analysis is that it implied equity value and enterprise value. So how you can actually use them? The practical process is, let's say you are valuing a company a mid-sized company. Let's assume that mid-sized manufacturing company, and you will go through I mean, the process will be first you will compare company analysis, the trading comps. You will first compare those. Then you will do a precedent transaction analysis. And the goal here is to see that the multiples acquirers and see the multiples acquirers have paid for similar companies in an actual deal. Then the DCF cash flow, the goal should be to value the company based on intrinsic value of the projected cash flow, and you know how the DCF is done. We have discussed it previously also. And if we combine the results, so we will get a valuation multiple. So we will get the different multiples from different valuation. So in that case, you can do a football field chart, and you can find the approximate. Uh, you can find. You can find a range in between the valuation should be. So if you are calculating it in, if you calculate this thing, if the median EBITDA if you want to calculate this thing, you can do that. So if you interpret the result, compare the overlaps, that's your fair valuation range. If you are comparing the overlaps from all the three valuation methodologies, that will be your result. And adjust for qualitative factors always, like growth potential, market positioning, and risk profile. And then you will arrive at the final recommended value. Football field. We have discussed about football field. Uh, and I will show you one more time what a football field is. So, let's assume that using comparable valuation, this is your valuation. You have valued the company from 31.81 to 63.9. Precedent transaction value, you have you have reached to a conclusion that using the precedent transaction value that previously these kind of companies have been acquired at a rate of 44.81 to 65.9 uh, per share, dollar per share. And as per DCF, you are getting a range of 36.81 to 55.9. The comparable values, what the market is saying, 31, the multiples, 31.81 to 63.90. Precedent transaction analysis, the previous merger and acquisition deal, these kind of companies has been sold for this this price per share, bought for this price per share, and as per DCF, you are getting a range. So the range where everything overlaps, that's your that's your recommended valuation. So this is the football valuation field is very helpful, and uh, it's good to have this good to learn. So let's conclude here, and we will start with question number 21 onwards in our next video. Thank you. Thank you for attending the lecture.